Well, welcome everyone to Women on Wealth. And this is the third and final of our lending landscape series with Anna DeSimone, who is author of Live in a Home That Pays You Back. So Anna, welcome back one last time. And thank you again for all of your time doing this.
Oh, thank you. It's funny, things are changing so much that, 3 short conversations with you over the past month and, so much is happening.
Yeah, no, I'm excited. I'm excited to have this third and final one, which is really addressing the life stages of home ownership.
Yes.
And we talk a lot in finance around individuals having a life stage and how everyone's unique, of course, but there are a lot of similarities as you go through your 3 life stages as to what you want, what you desire, what you fear, and what your goals may be. So I guess if you can kick this off and talk about, first what these life stages are and, how it affects, someone's financial plan.
Well, it's funny in buying a home, historically, you won't really see people talking about life stages that much. And I
Yeah.
think it's because traditionally, people bought their starter home and they say, this is my home for a lifetime.
Yeah, fair.
But people bought starter homes when homes cost 100 or 150 or $200,000. But now when you're living in an area where homes cost $500,000, you're thinking, what starter home?
Yeah.
This is my home for a lifetime.
Right.
And so if I'm sitting here today with Julita talking about the 2 or 3 stages of home ownership, what I'm really talking about is to make sure that don't think about your home as how long you're going to live in it. Think about buying a home, renovating it, refinancing it, maybe buying a vacation or a second home, and then downsizing. I mean, these are really part of life stages. And it is so important, and I really want to emphasize today that you incorporate a conversations along with financial planning with a tax professional, because one of the things about home ownership and owning real estate is there are so many tax implications that we tend to forget about.
Mm-hmm.
But Julina, I wanted to mention that 2 days ago, the new census reports came out, and I have been busy. And I want to just start off our conversation today with a couple of interesting facts,
That would be great.
especially benefit women. And then we could get on to what I call, phase one of buying the home.
Perfect.
And just to recap, the first 2 programs that we did podcast, we talked about the very high rate of appreciation for owning homes in Connecticut, just 14.5%.
Yeah.
So if you bought a house in Connecticut for 800,000 3 years ago, that house would be worth over $1 million, about $1 million and almost $50,000. If you bought a house for 500,000 5 years ago, you would have earned $250,000 in appreciation. So,
Yeah.
real estate, investing in real estate in Connecticut is very wise, it's very sound, and it's very stable. But for the women in our audience, I just wanted to share with you some new census statistics that I just discovered only in the past 2 days because of these new announcements. And that is the single women are the fastest growing share of home buying market in America.
Hmm.
And there has been a 30% increase since 2010. Now,
Wow.
that is a report by the National Association of Realtors. Now, Freddie Mac did a study about why women are the fastest growing segment in real estate. Well, for one, women are more interested in owning a home, but according to Freddie Mac, women have higher credit scores.
Huh.
Now, the new census reports that I just got 2 days ago tell me that 21% of children in America are living with their mothers. Now,
Right.
that's just with their mothers. And what is really going to surprise you is, of course, the census tract tells us what, the average wages are in the United States, which are, a little bit lower than they are in the Northeast. It's like comparing the average householder earning $70,000 to $77,000
Okay,
annually.
sure.
But what is not surprising is on a national average, women are only earning 85 cents on the dollar than men.
Still.
However, here in Connecticut, according to the Pew Research Center, women in their 30s are earning 98% as much as men in the New London metropolitan statistical area. Women are earning 94 cents on the dollar compared to men in the New Haven metropolitan statistical area.
Hmm.
And in Boston, it is 97%
Wow.
ratio.
Okay.
So the wage, the male female gap in wages has always been, an eye
Yeah.
opener in the United States. And the Census Bureau started tracking the wage gap in 1960.
Right.
And so in 1960, the wage gap was actually 60 cents on the dollar, which is coincidentally.
That's
And
amazing.
I
Yeah.
kind of want to share that. So women today who are looking to buy their first home
Hmm.
are women who have gone through some kind of a separation or divorce or whatever, that had to sell their original home, and now they are buying a home on their own.
Right.
Keep in mind that if you're applying for a mortgage from a housing finance agency and you're looking to get one of the discounts, as you qualify as a first-time home buyer if you haven't had a shared home with your former partner for the past 3 years.
Okay.
Usually, sometimes it's only 1 year, sometimes it's 2 years, because every state is going to be different. And
Okay, so it's a
Fannie
state
Mae and Freddie
differential.
Mac, have programs too. So just keep that in mind. If you did go through a change
Hmm.
and you were looking to start over on your own, you are still eligible to get, some of the discounts and incentives in your mortgage, and will be treated as someone who is buying their first home.
Okay, great. That's
And
a
so,
great point.
so getting back to the starter home, I mean, how are people buying starter homes today in the Northeast when homes are averaging $5, $6, or $700,000, and it costs $150,000 in annual salary to buy that home?
Yeah.
And so there are some different options for people. And one option I want to mention is, let's say that you are working in Stamford and you have a beautiful apartment that you're renting, and you're happy. You may be a one-income family or a two-income family. But I'm using Stamford as an example, similar to Boston, and it's similar to some metropolitan areas that have robust workforce. At Stanford, we have hospitals, we have finance companies, we
Yeah.
have a lot of media companies, the television industry in Stanford that people don't know about. But if you are living and working in Connecticut
Mhm.
and you're looking to buy a home, you're seeing homes that cost $1 million, and you're driving further and further away from your office. Let's say you're working at a hospital.
Mhm.
Wherever you're working, whether it's Stamford or Hartford or the Greenwich Hospital, wherever, housing costs may be out of reach for people. And
Sure.
depending on your family and your household structure, you may not be interested in having a 1 or 2 hour commute to work every day just so you can own a home.
Of course.
And you may be very happy renting where you are.
Yeah.
So one of my suggestions about the starter home option is, you can be a homeowner by buying a ski lodge in Vermont. I mean, you can be a homeowner by buying a beach house in Rhode Island. We just look at a map and look at a 100-mile radius.
Mhm.
And what I'd like to share with you is, spending $200,000 or $300,000 on a beach house or a year-round recreational home in Vermont. And I love to suggest Vermont because not only can you go skiing, and there are a lot of places to have water sports, but a lot of the properties that are for sale there that are ideally suited for second home ownership are also good for beach swimming. And so you keep your apartment, you
Mhm.
have long weekends, and you and your growing family, have a place that you can call your own, have a place where you can play the music loud, have the place that you can decorate. But the bonus to all of that is you have a property that is absolutely going to put money in your pocket,
Mhm.
because homes in along the shore of Connecticut or Rhode Island
Right.
are that you buy that are unheated now, that are not year-round living homes, beach communities, are
Mhm.
going to go up in value.
Right.
And then you have a home in Vermont that is going to go up in value. So you can be a homeowner and still make that 10, 15, or even 20% a year appreciation.
Right. And Anna, you don't know this, but that's actually exactly what I did.
Oh, you
When
really?
I rented in
Oh,
Manhattan and around Manhattan with my early stage of
oh,
my career, I bought a
oh,
condo in Vermont and
oh,
I
you
rented
did.
it for income. And yep, so I'm
I
just,
had no idea.
I know, I knew you didn't know. We've never talked
Yeah,
about it, but
no,
I
I
think
had
it's
no
a
idea.
brilliant
That's
idea
great.
because it worked for me. So,
Well, one of the things that I discovered recently is that Amtrak has a train called the Vermonter.
yeah,
And that train,
yeah,
I took it from Stamford to Northampton, Massachusetts to go to my niece's wedding.
yeah,
But you can stay on that train and go all the way to St. Albans, Vermont.
right,
There's like 20 or 25 stops.
exactly.
And you can go to Brattleboro. So as your kids get older,
Mhm.
when they're 12, 13, or 14 years old, they might say, I want to take the train up to the beach house because
Right.
dad's
Well,
up there by himself or whatever.
and it's a
It's,
great point because you have flexibility. A lot of individuals have flexibility with their career right now, to be able maybe to
yes.
utilize it more than I did at that, this was for me back in 2010. So yeah,
Yeah,
that's great.
when people are working from home, but also if you're driving up to Vermont in one car and one person wants to leave early and the other one is going to stay with their computer and work remotely
Yeah,
and stay in Vermont, they're just knowing that that train is there. And of course,
sure.
the same thing is the train goes to Rhode Island. It goes to Kingston and Providence and
Right.
all through Rhode Island or Boston. And so when you're thinking about your home and your life stages and your plan for home ownership,
Mhm.
and think about your hobbies, where you're working, where you want to be, and also think about the fact that no matter where you're investing,
Yeah,
you want to be happy. It's a lifestyle thing. And
yeah,
being happy isn't always having that McMansion. If it,
right.
and we're still talking about your first home now. I mean, this is in, when you're in your 20s or 30s or 40s and you're still working. But I mentioned the beach house,
Mhm.
and I want to segue into the move up house,
Okay.
because once you have your start home, you might outgrow it. You're making more money, you've built up some equity, and you're thinking, okay, it's time to get the $1 million McMansion.
Mhm.
Okay, so what are our options now? Well, in Connecticut, of course, we have the very long shoreline with, Long Island Sound, and then we have a lot of other waterfront areas. But I just want to mention to you that in America, there are 51 million households that are living in areas that are at least a moderate threat to annual losses from national disasters.
Right.
So when you're looking for that shoreline home, or you're looking for the more expensive move up property, you have to remember that in addition to paying a much higher monthly mortgage payment, you will be paying much higher taxes. If it's a condominium community, you'll, of course, you'll be paying condo dues.
Sure.
But what's going on right now in America, I'd like to just share with you that when you're moving up and buying the more expensive home, you want to make sure that that house is climate resilient.
Okay.
We we are in an area that does have a moderate threat to national disasters, mostly, not wildfires, but pertaining to floods.
Right.
But to give you an idea, in 2021, the National Flood Insurance Program processed 45,000 claims in the United States, totaling 2.2 billion.
And do you think,
And
Anna, that's an average? Is that a general average, do you think, or was 2021 significantly different?
It was significantly different. I'll just give you another statistic. In 2021, there were 14.5 million properties damaged in the United States at a cost of $56 billion to recover the aftermath of both wildfire
Wow.
and floods.
Yeah.
Now, the homeowner disaster repairs and expenditures doubled in 10 years.
Wow.
This is
Okay.
what climate change is doing.
Yeah.
So in 2009, as a nation, we spent $11 billion in disaster repairs, and we spent in 2019, we
Right.
spent $26 billion. So there's,
Mm.
we have a challenge to improve the resiliency of our homes, and we also have a challenge to mitigate the risk of extreme weather-related disasters.
Okay.
And so when you have $2 billion in flood insurance claims, what happens in the insurance industry is there are certain areas that are now turning to risk-based pricing.
Okay.
So if you've been reading the news lately, there are a lot of homeowners in Florida that can no longer afford insurance. It's because of the risk-based pricing.
Yep.
And so as a nation, the destructive impact of climate change is a threat to not only homeowners because of the potential damage, but it's also a threat to our housing finance industry. Because if people can't afford to repair their homes, they get delinquent on their mortgages.
Sure. Yeah.
And
Like a
so,
spiral.
yeah, well, you can be quoted $2,000 or $3,000 a year in, homeowners insurance on that McMansion, and then find out that your taxes, or you might be paying $20,000 in taxes, and then you find out that your city or town has to mitigate some losses to some floods, and your taxes can suddenly go up. And I know I sound like the Green Reaper, but after all, you heard it here first on Women on Wealth. These are the things that you want to think about the future when you're thinking about moving up to a larger house.
Right.
People are always focusing on, if I buy this $1 million house, am I overpaying it?
Right.
What are the interest rates going to be? And they tend to be we can become myopic on the drivers of what we're always focusing on, the interest rates and the property values.
Exactly.
And what I'm saying, look at the potential for the increase in your hazard insurance or your homeowner's insurance.
Yeah.
So I want to go back to that beach cottage in Rhode Island on the shore, or other parts of Connecticut that may not even have year-round heat.
Mm-hmm.
The good news about that is you're not going to have a $3,000 insurance bill. And you don't have to worry about, I hate to say it, but if something does happen, if there is a weather-related disaster, you're not going to be without your primary residence, beautiful $1 million home.
Right.
And so,
Yeah. That's a
if
great
I can just recap the stage 1 and the stage 2 moving up.
Sure.
Look at the size of the house that you buy as your starter home.
Mm-hmm.
Go to the town, go to the city, start looking up the requirements for getting building permits. Find out whether or not you can expand 20 feet to the right, 10 feet to the left, 30 feet in the back. And the reason why I'm saying this is if you love where you live,
Mm-hmm.
and you can afford a bigger house, you might want to think about just expanding the house that you're in and skip the phase 2 McMansion stage.
Exactly.
And or buy a second home.
Okay.
That's what
And
I'm saying. That
yeah, and that's such a great point, because so many, I have to imagine that very few do that. And so you don't want to come into that unknown too late. So
Well, the other thing about that is people have a big concern. Let's say they have kids in school. The kids love their school. They love their neighborhood. They're happy with their house, but the family has outgrown it.
Hmm.
The problem is because we have a 14% a year rate in appreciation,
Yeah.
someone who is moving up from the starter home to this larger home runs the risk of overpaying.
Okay.
I will tell you that statistically, there are more buyers for people who want a moderately priced house. And so
Okay.
when we have a problem with
Yeah.
a buyer's market versus a seller's market, it always takes longer to sell a multi-million dollar home. I mean, we read about these
Yeah.
castles and estates and
Yes.
Hollywood people. Oh, Richard Gere has a home in Westchester and he suddenly dropped the price $10 million.
Right.
So his estate went from 30 million to 20 million. I mean,
Not
it's
everyone may want a tennis court or a
that's
basketball court or a bowling alley or who knows, right? So,
it always takes longer to sell a home
yeah.
because there's fewer buyers as you increase. But
Mhm.
you know, if a starter home in Connecticut is costing $700,000 for a family,
Right.
that means
What does it mean
the
for phase
people,
two?
yeah, phase two, it could be 2 or $2.5 or $3 million. And that's when the taxes really begin to go up. And you know what's funny?
Yeah.
Kids don't stay small forever. And when you outgrow a house,
Yeah.
before you know it,
Yeah.
you know,
And
they're
it happens
saying,
all the time. It's so common, right? It's one
yeah,
of the most
kids,
common
yeah,
scenarios that we find.
yes,
So,
yes. And
okay,
so think
great.
carefully. And the other thing about the move up from the little house to the big house is the the long-term capital gain, the adjusted cost basis.
Yeah.
Julina, as you know, because of the line of work that you do, you're talking to people about, what is your long-term goal or your plan for accumulating wealth.
Mhm.
And when we buy a house and close on it, it's exhausting. So what I'd like to suggest that after you unpack all of your boxes and you sit down and breathe a little bit,
Mhm.
get out your closing statement. Okay.
Okay.
And what you're going to see when you look at the closing statement is you're going to see a lot of items that are going to be on your accountant's checklist when you file your tax returns the following year.
Right.
And that's what leads us down to that rabbit hole where we forget about the long-term future. Because our accountant's checklist is going to say, did you buy a house? Did you sell a house? What did you pay in mortgage interest on your closing? And
Mhm.
what did you have any private mortgage insurance? What were the property taxes? And did you have any points? And so this is one-dimensional thinking because all you're really doing is getting out your paperwork to react to what your CPA is asking you for.
Right.
But what you're going to forget about is that closing statement has thousands of dollars worth of expenses and checks that you wrote out at closing that are not going to be tax deductible. However, those items need to be added to your spreadsheet, which I'll call the adjusted cost basis. We talked a little bit about this with the last podcast.
Yes.
Every time you buy a house, your goal is to shrink the profit that you made on that house. Because when you're living in the part of America where the average home might net you $250,000 capital gain over the lifetime of your owning that home.
Right. And as a reminder,
That
Anna, the way to shrink that basis, the easiest way to shrink that basis, right, is through improvements, correct?
improvements. Well, the IRS, I mean, as Jelena will make this very clear, is we can't offer any kind of tax advice. But my advice to you is
Sure.
to go onto the irs.gov website and start Googling things, because you'll find that the IRS is saying if you are increasing the value of your house, then this will be added to your adjusted cost basis.
Yep.
And so, all right, you're going to remember writing out a check to your contractor for painting your house for $10,000. But you're probably not going to remember the time you went to Restoration Hardware and spent $1,000 on a lighting fixture. You're
Mhm.
not going to take that lighting fixture with you when you sell. So whether or not you have plans to sell your house,
Mhm.
each year that you're living in the house, if you go
Right.
into the garden center and you're buying a half a dozen trees or 30 or 40 shrubs or several hundred perennials, you're doing all of that work. So you're not writing out
Absolutely.
checks to contractors. You add this to your spreadsheet.
And
So,
Anna, adding to the spreadsheet, because I have to imagine the question that people are thinking as they're listening to this is, do you have to keep a record of those? And I know we're not tax advisors, but do you
right,
have to
right.
keep a record of the receipt? Well,
I don't think so. I mean, because, well, first of all, when we
I mean,
do our
more
taxes,
information is better, but
we're looking at our MasterCard and our Visa card bills. And we're saying, oh, I bought something at Restoration Hardware or Pottery Barn.
right.
Okay. But we're usually looking at our checking account statements when we're paying our contractors. But
Yeah.
unless you're getting an audit
Mhm.
and you have really huge adjusted cost basis
Sure.
figures.
Right.
I mean,
There's something
yeah.
glaring that they want to look at.
Yeah. So, to prepare for this podcast, I will just share something with you, because these are actual figures. I sold my house last year
Mhm.
and I paid like $50,000 to a real estate commission and about $25,000 in what call the Connecticut transfer tax
Right.
fees. I
Right.
mean, that was $75,000 that came out of my pocket.
Mhm.
So naturally, I'm walking away thinking that's less money than I got to spend.
Right.
But I looked up my accountant's, worksheet on my taxes this morning so I could share with you what these figures are.
Okay.
On my adjusted cost basis for selling my property last year, she included that I had $98,000 in expenses from
Okay.
the sale.
Right.
Now that's over and above the money that I spent on the improvements. And so the expenses for selling, it's a little bit like the title insurance when you buy a house, the legal
Mhm.
fees, the private mortgage insurance, all of these things that are not tax deductible when you file your taxes. You
Right.
need to
Yet.
make sure that you're writing this down on your other worksheet so that
Okay.
when you go to sell your house. So the profit that I made on my last home, and I did make a profit on it,
Mhm.
was shrunk and shrunk and shrunk.
Right.
And I originally was thinking it was going to be because of the work that I did,
Absolutely. Yeah.
the
And
improvements. That
I think that that's a
98,000
critical
made my
point.
day.
Yeah.
Okay, so it wasn't in my pocket, but at the same time, so we can't forget about the fact that over our lifetime, we have this $250,000 individual.
Mhm.
And this was since the 1997 taxpayer relief law. And of course, all of this is subject to change, but if you own a home in partnership with your spouse
Yeah.
or another person, then that would be a $500,000 in gain. But when you're living in an area like the Northeast, where the average home is like
Yeah.
$700,000,
Absolutely.
you can go through that $250,000 pretty quickly.
I'm thrilled that you brought that up, Anna. Thank you, because I also, relating that to finance and investing. We're in 2022 down markets. And, that's one of the things as financial advisors we try to do is we try to mitigate and we take losses in portfolios to offset gains and to adjust the basis for individuals going forward so that we can mitigate that tax effect on them later in life. I think it's a very similar strategy that often gets lost in either investing or in home ownership.
It's funny because we think about financial planning and we think about how much money we're going to have in the bank and
Yep.
but we're not thinking about all of the implications, the tax implications about home ownership. And the
Yep.
reason why I
Completely
mentioned
agree.
the climate resiliency is because you can have a devastating shock
Yeah.
by, something else. But
Okay.
speaking of devastating,
Yeah.
I I want to talk about the final stage, which is all of us baby boomers,
Mhm.
and what to do about selling their home, and what some of the options people have. And
Yeah.
I think that what we do in our senior years is we tend to buy real estate, and we make our priorities and our choices are because we think we're going to be happy.
Yeah.
So we buy a home based on how we think we're going to feel, what our lifestyle would be
Yeah.
like when we get there.
Yeah.
And so a person that I met briefly in Manhattan was in her 60s. And of course, she had an apartment in Manhattan and she bought a house out of state. But she doesn't like mortgages. She's not comfortable with borrowing money.
Okay.
So she took $1 million out of her IRA account
Mm.
and paid all cash for this second home.
Okay.
But she never moved in because she realized this isn't the lifestyle that I thought it would be.
Wow.
So she ended up selling the house at a little bit of a loss, and she had a real estate broker to pay.
Yeah.
And it was about $1 million. So she lost about $75,000.
Oh,
But unfortunately, because she took the money out of her IRA account, when she sold the house several months later,
mm-hmm.
well, the money that she took from her IRA account, and correct me if I'm wrong, Julina, that was treated as ordinary income for her on that deal.
Absolutely. Yeah.
Okay. So she had $1 million in her IRA account, withdrew it,
Mm-hmm.
and then ended up paying $500,000 in income taxes.
Yeah. I'm assuming
Because
her tax bracket jumped up pretty
she said
significantly.
she was in a 50% tax, but I will tell you that in the short conversation I had with her, she told me she was in a 50% tax bracket and it was the biggest mistake in her life. And
Mm-hmm.
she told me this 3 times. I don't know this person's name, but I did ask her permission to share the story. So I just want you to know she gave me permission.
I think that these are great conversations to have with an accountant, with an advisor, just to think of what the other longer term ramifications may be when you make these decisions.
Well, I think the reason why I wanted to share this person's story was because she bought a second home, imagining what kind of life she would have there,
Yeah.
and then never moved in.
Mm-hmm.
Because I guess in interacting with neighbors or traveling around or whatever it is that she did, this happened to be an area where she went to college and worked for a while.
Okay.
So she had good memories from 50 or 40 or 50 years ago, because she's
Okay.
only in her 60s. So what I'm saying is when you're choosing that second home, think about so many different aspects outside, selling your home. Do you
Mm-hmm.
really, people sell their home because they think it's too big and it's too much work.
Yeah. Yeah.
But there were studies done because I wrote a book on reverse mortgages many years ago. And of course, what we learned at the time was that people were selling their homes and they actually were healthier and happier if they could have stayed in their home.
Hmm.
So sometimes it's worth it to get help and get gardeners and people to help you.
Mm-hmm. Yeah.
And, another thing that I would like to say on this podcast is we think very much about being having financial independence.
Sure.
But as women, we need to be emotionally independent. And by
Yes.
that, I mean, you have to be decisive.
Yeah.
You can't wait. If somebody tells you that you have a leaky faucet, you have to fix it.
Mm-hmm.
And a lot of the problems that people have as homeowners is they procrastinate and They
Yes.
don't trust the contractors. With Angie's, I probably vetted a dozen different contractors just using Angie's list.
Okay. Yeah.
And so to be emotionally independent, you have to take the bull by the horns and take care of the house. And so if it is going to be too heartbreaking to sell the home that you raised your family and you want to hold on to those memories, the one thing that is important to do is be prepared to start having people do the work for you.
Okay. That's a great point.
Because we
Yeah.
all know people who say, well, I've been waiting 6 months for your father to fix this, and I've been waiting a year for your brother to come and, and chop down that tree. And people, with the way people are today with their lifestyles, the same thing applies to people who want to be snowbirds and buy that house in Florida
Right.
and keep their house in New England. That is all great,
Yeah.
except that you can't expect family members to hop on a plane every time you
Yeah.
need. My daughter comes from Boston if I have a medical situation, and she is coming here
Yeah.
soon. But
Well, it's a great
it's
point.
different when you're 3 hour train ride or drive than
Yeah.
hopping on a plane to be with
Sure.
your parent because they're going to have a medical procedure, something done.
Yeah.
It's hard. You have to be independent
Yeah.
and taking care of your home and your
Mhm.
travel, your transportation,
Absolutely.
and
And I
making that
think
choice.
home ownership, we know, is extremely emotional. It's one of the largest financial decisions we make. And I think finding that balance in that decision is a challenge, but it's important. And so I think you addressed it perfectly on how to
Yeah,
consider it.
yeah. Well, even downsizing, it's emotionally being independent so that you don't sit around wondering, who's going to take my dining room set, or get upset because nobody wants it. I can't imagine my granddaughter wanting my dining room set, and I have a new one from Ethan Allen. But my daughter, on the other hand, has this ancient 200-year-old dining room set my that was been in my family for years because she
Wow.
treasures those antiques.
Sure.
My granddaughter's like me. We like the minimalist new stuff, kind of travel lightly. So,
Yeah.
to making decisions to downsize, the key word here is to get help.
Okay. Yeah,
And
absolutely.
in closing, I also, because I mentioned Florida, I did some research on this too this morning.
Okay.
Every state has their own laws about wills and estates.
Yes.
And we have an old saying, and we call it the Florida trophy wife law.
Mhm.
When people become widowed and they remarry, they really need to get a tax advisor and a financial planner and a estate planner that can research the laws of any state that they're looking to relocate to.
Absolutely.
Many people remarry for religious reasons, and I respect that. But
Mhm.
I have known too many people whose siblings lost their entire inheritance. At best, you might get 50% of your parents' estate
Mhm.
because the laws are very strongly in favor of the surviving spouse. That's why they're called the trophy wife laws.
Yeah.
And so the financial plan doesn't just end with the buying and the selling of the last house that you're going to own. The financial plan, life stages, actually ends with the property that is passed on to your heirs.
Mhm.
So if I left my home to my family and my grandson decided he wanted my house and was going to live in it, there has to be an official appraised valuation of that house.
Right.
And the adjusted cost basis of all of that work that I've had done over the years, that is going to affect how much tax my grandson would pay. because he's going to inherit my house.
Right.
And so it's kind of like a never ending spiral, but
It is.
you really need to think about all of the different decisions
Mhm.
of your life and, just surround yourself with, the right people.
Absolutely. Yeah.
And yeah,
It is
okay.
a very large puzzle we all live in, right? And putting the pieces together can be complicated, and getting help is, I think, the most important thing. So,
Well, we all want to leave that legacy to our children and our grandchildren. And I can understand. I've known a few, I had a few employees that this happened to.
yeah,
They were devastated when their mother died,
right.
but
And
then a year or
I
two
can
later.
easily relate that from an investment standpoint in regards to the type of account that you have, right? And what that account means, and beneficiaries, and how it's titled. That's incredibly important.
Well,
Same
well,
thing.
yeah, yeah, but
Yeah.
people have remarried a year or two later, and then they've passed on themselves. And then the person that they were married to only a year or two, often out of state, ended
Yeah.
up getting half or all of the home and of the estate. And what my employee, the problem that she had, just constantly flying down to Florida, is they couldn't sell the home and divide up the the proceeds from the home, because the law at the time was that a person could not be asked to leave their house. They need a place to live.
Right.
And it's funny, the existing law still says you still need a car to drive.
Mm.
There's even automobiles that are part of this act. So,
Yeah.
while you're young and while you've got income and you've got good advisors, I mean, it's the time to really start thinking about all of the possibilities, the
Right.
changes that your life
Absolutely.
can take. But
Yeah. Those are
okay,
great points, Anna. Thank you so much.
all right.
Do you have any last thoughts as we sign off on the third and final podcast? And by the way, I would encourage anyone that hasn't listened to the first two to please go back and do so.
The first two podcasts we did about interest rates, and then the second one was about property values and the benefits of going green, of doing home
Absolutely.
improvements on your properties.
Yeah.
But
Some great points in each one. Anna, how can people reach you?
people can always email me through my website, annadesimone.net.
Perfect. AnnaDeSimone.net.
Yeah.
I think the points that I think are important, as I sort of summarize this, is that getting help and advice can be critical. But number two, just being organized and keeping track,
Yes.
having a spreadsheet of your home. I'm already thinking of some points that I need to do when I talk to my husband about this later. So,
Yeah.
so thank you.
Yeah, I know. And well, I'm happy to share my tax return with you if you're thinking, what would it be like? I mean,
Yeah.
it's we're making, and the other thing too is we're buying homes and we're selling homes we are so wrapped up in the busyness of it all.
Sure.
Hiring the moving trucks, getting everything packed and
Yeah.
unpacked, and
It's so
buying
time
and selling
consuming.
and renovating. It's all very stressful. And
Yeah.
so it's just too easy to forget about the tax implications
Yeah, absolutely.
that you might have. Anyway,
Great. Thank
thank
you,
you so
Anna.
much for inviting me to 3 of your podcasts.
No, please, not at all.